All right, so here we are, and now we are going to attack or attempt, I should say more so attempt this particular example for the allowance method. All right, so on we have this, let's journalize the below transaction for Zippy Interior Company. It's a restaurant supply company that uses the allowance method. Okay, so on May 24th, they sold merchandise on account to Old Town Cafe in the amount of $18,450, and the cost of goods sold was $11,000. Okay, so let's see what this journal entry on May 24th looks like. Okay, so 5/24, we have a debit to accounts receivable in the amount of $18,450. And then my credit is going to be to sales. Okay, $18,450. We're going to also capture that cost of goods sold. So going back to chapter 5, that's where we learned about cost of goods sold. It's going to be a debit to cost of goods sold and a credit to inventory. It's a credit to inventory because our inventory is decreasing, right? All right, so now moving on, we are going to capture what happened on September 30th, okay? All right, so on September 30th, 9/30, we received $6,000 from Old Town Cafe and wrote off the remaining amount owed on the sale from May 24th as uncollectible. All right, so I'm going to split this journal up entry into one, but what I should warn you is that in Cengage, it's going to ask for only one, and I'll show you how to do both, okay? All right, so we received $6,000, so what we're receiving is cash in the amount of $6,000, and then our accounts receivable as a result is decreasing. They're fulfilling their obligation to us. And the remaining amount, which if we did the math, we initially sold it at $18,450. They have paid $6,000, right? So the remaining that they owe us is $12,450. Okay, and so they're saying the remaining of it, which is this amount, is what they're gonna deem as uncollectible under the allowance method. So our debit is going to be a debit to the allowance for doubtful account and a credit to accounts receivable in equal amounts of $12,450, $12,450. Okay. All right, so now if we, again, as I mentioned before, I'm going to show you how to combine it because in Cengage, it's going to ask for only one journal entry. So the combined version of this journal entry looks like this. So 2, 2, 1 entry. Okay, so what that looks like is on 9/30, this journal entry looks like we're going to take all of our debits and all of our credits together. So our debit is a debit to cash in the amount of $6,000, a debit to the allowance for doubtful account in the amount of $12,450, and our credit, the credit here and credit here, if we add those both up, is accounts receivable in the amount of $18,450. This is Cengage approved. Okay. All right, so now we're going to move on to the very last one. Now, the very last one is recognizing, it says on December 7th, they reinstate the account of Old Town Cafe that have been previously written off on September 30th and received the full amount. So here they're jumping for joy, right? Like they wrote it off and now they're going to be able to collect on this, right? So as any company, you will be super excited and super surprised if a company did that. All right. So this is what my journal entry looks like on December 7th. So 12/7. So first off, if they're reinstating something, that means that what they previously written off, which was this amount, they must now back out of it or make it zero, right? So they originally wrote it off and now they have to say, okay, this no longer is the deal. So what that looks like if I'm doing T accounts, right? I'm going to have the allowance for doubtful account, and I'm going to have accounts receivable. So debit, credit, debit, credit. So when I initially wrote this off, it was a debit to accounts allowance for doubtful account for 12,450, and then a credit here to accounts receivable for 12,450. Now, if I'm gonna reinstate it, I must do the opposite of this, right? So the opposite of my allowance for doubtful account is to do a credit for the same amount. And then the opposite of this is to do a debit. This is wiping the slate clean. I am wiping that write-off off, okay? So again, remember that your T accounts are only a visual representation of what happens. We have to really journalize it now. So my debit is going to be accounts receivable in the amount of the 12,450, right? And then my credit is going to be the allowance for doubtful account in amount of the same there. And since they're paying us in cash in full, right? That's what they tell us. Then on that same day, we're going to collect the cash in the amount of 12,450. And then our credit is going to be accounts receivable, 12,450. Okay. So what I want to make sure I convey is that best case scenario, right? So I'm going to collapse this a little bit. So whenever you're a company, whenever you first start off, you really would like the situation to be like this. Whenever we first recorded this transaction on 5/24, it was accounts receivable, right, of the 18,450, and then the credit to sales. I'm gonna leave the cost of goods sold out for a second because we're just gonna leave that out. But ideally, what you would have wanted on September 30th it to look like was a credit to, a debit, a debit to cash in the amount of 18,450 and a credit to accounts receivable, right? This is the ideal situation, right? But sometimes that doesn't happen. And sometimes when you chase a customer or try to get your money, they only pay partial of what they owe to you, right? And so while this is ideal, sometimes this doesn't happen. And sometimes you have to go through these situations, right? In order for you to get your money, or they respect your wishes and come back and pay you, okay? So hopefully that made sense. This is what we've learned from like chapter, I guess 1 through 4, but this is ideal, right? But sometimes this does happen, okay? So hopefully that makes sense. If you have any questions, please let me know.